Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about JEPI and JEPQ from JP Morgan. Now these are two income ETFs that I have reviewed before. I'll link those videos up above. But I saw a recent interview with the fund manager, and it got me thinking it's a good time for a recap on these two because I continue to add to these positions every single month despite my slightly bearish view. Now you're better off if you just bought the Qs over the last few months. It's really taken off 8 stocks, dragging the rest of the market along, but the fund manager came out. He kind of explained some of the things about the ELNs that often confuse people, so I thought we'd run through that today. If that is what you're looking for, please stick around. Whoop. So let's start with this recent clip from CNBC with Bryn from Requisite Capital Management. She's often a guest on this show. She's discussing the recent rally. It's mainly involved 7 stocks, but really saw the Qs make a big move. I mean, year to date, the Qs are up 33.5%. Compare that to JEPQ, which is still up nicely, about 16% plus some monthly distributions. But still, we're looking at about a 2-to-1 advantage if you simply own the Qs. But I think she explains my thoughts pretty well on these two products and why I still prefer my money invested in JEPI or JEPQ at this time in this particular market. So take it away, Bryn.
We went into this year with the narrative of there's a wide range of outcomes. And I agree with Steve about why he has been negative. But where I don't agree is as an asset allocator, you want to have a wide range of, if you have a wide range of outcomes as your outcome. We owned the Qs, but did it via JEPQ with covered calls. We owned energy, we owned healthcare, we owned JEPI with more covered calls. So we were more defensively postured, but invested.
Thank you, Bryn. I'm right there with you, but I'm probably, well, almost certainly, less invested overall. So it's always good to see the pros involved in something that you're buying. So Bryn, Requisite Capital Management, and Dave are all buying JEPI and JEPQ. But it did seem a little bit odd to me. So I ran out and I looked at the 13F for Requisite Capital Management. This would be at the end of the last quarter, so end of Q1. And this is a disclosure of what they actually hold in this fund. But it looks like they have about 800 million total in assets under management, catering mainly to high net worth individuals. Sounds pretty nice. The odd part is that they primarily invest in ETFs, with their #1 holding being JEPI at nearly 35% as of their last 13F. And about 6.5% of that is in JEPQ. So together over 41% in just those two funds. Now, I say it's a bit odd because if I'm paying someone to manage my money, it seems like a little bit of a cop-out to just run over and buy JP Morgan products. Am I missing something there? So if I want to buy JEPI, I pay 35 basis points, right? 0.35. If I want to have Bryn or Requisite Capital Management, I think I have to probably pay them 50 basis points, and then they're going to go buy a pre-made product. But anyway, we can buy this ourselves for 35 basis points. Now, what many people do buy this for is the income. So really quickly, this latest distribution that we saw for both of these funds was 37 cents for JEPI and 36 cents for JEPQ. If you annualize that over 12 months, that translates to 8.2% for JEPI and 9.2% for JEPQ, which is down from about the 12% that they were hanging around at for a while. But as we see volatility decline, when we're selling these out-of-the-money calls, we're going to be collecting less premium from that. So we're going to see a decline in those payments that we're going to receive month to month. So that's fine with me, but you do have to understand that portion of this fund. You are going to see fluctuations in that based upon volatility each and every month. Now, the rest of the information from this video is going to come from an interview that I saw with Hamilton Reiner, the fund manager, that was done by Adriano, who runs a YouTube channel up in Canada called Passive Income Investing. So go check out his channel. He does all kinds of videos focused on all types of income ETFs. So if you like this kind of content, go check it out. I'll link it down below along with the full interview. But Hamilton, who looks just like Ed Helms, by the way, or the Nard dog from The Office, or Stu the Dentist, whichever one you prefer, started out by talking about his background. Then he started jumping into JEPI and JEPQ, or actively managed, which I think is really important. And then he starts talking about how these funds are kind of like his children. You know, he really cares about these strategies. And then we kind of get into the meat of the interview. So I'm going to jump into the highlights and get you out of here. Now, both of these funds are managed the same way. One is just selling index calls against the NASDAQ, while the other one is doing index calls against the S&P 500. And the composition is slightly different as well based on the S&P and the NASDAQ. So he starts off by saying, I always sell out of the money index calls. And that's good. That's what I like. That's what I'm looking for. I don't want to sell out the money. I want to sell out of the money index calls. That's a strategy that I would prefer. Now, a difference there too is if you think about DIVO, which I'm also a fan of, that sells against individual stocks. They're not trying to do this here. They're just doing out of the money index calls. So when you think about that, you're trying to lower your volatility and your beta. And that's something he says. He goes on to talk about how this lowers the volatility and beta of your portfolio, right? Collecting that income, lowering your beta. So if you're in retirement now, this might be a good option. You're going to smooth out some of those hills and valleys. Then at around the 7-minute mark, he starts talking about how he owns his own strategies, but as a total return strategy versus an income strategy. So for me, that means he owns shares of this. I don't know how many or what, but he's probably reinvesting those distributions probably in some kind of tax deferred account versus taking the income and using it now. So he's still relatively young, like me. So maybe that's a strategy. And then about the 9:30 mark, he also comments about neither strategy has any leverage, and he kind of stresses that whole point. And then they go on to start talking about market volatility and how that determines how far out of the money they sell these call options. Again, we're paying for professional management here. 35 basis points. So they got to determine whether they're going to sell 2%, 2.5%, or 3% out of the money to collect that premium and try to put it in our pocket in the form of a distribution. So obviously, that's going to be part of the reason we're going to see that distribution rate rise and fall as the VIX moves around. So last month wasn't outstanding, but the VIX, of course, was relatively low as well. Now, at the 15-minute mark, they jump into fees. And I thought this was really important. We keep saying 35 basis points. This has been a rapidly growing fund. That's part of the reason, the strategic reason probably behind it. Let's keep that fee relatively low and capture as much business as we can. It's very appealing at 35 basis points versus several others that I've looked at. Probably the best one I've seen, honestly. But he says he desires to keep the fees low so that it is not a determining factor for a buyer. I thought that was great to hear. Then they have a quick discussion on distributions. Those things we get every single month, basically saying that they want to distribute 100% of all dividends and all option premium every single month, not holding anything back. But how can you do that? Well, that leads into 18:53, 18 minutes, 53 seconds. I've got a timestamp for you where they start talking about taxes, which he leads into the ELN discussion. So this is going to be repeated several times. So he's definitely trying to drive the point home. The ELNs are a function of tax treatment, things like that. So he says, I'm not a tax advisor. So he's one of us now. He's not a tax advisor or a financial advisor. But dividends should be all qualified. He says option premium should be ordinary income. The goal here is to avoid return of capital by bundling all of this inside an ELN. So they put some equity market exposure plus their sold options in a short-term ELN. And that's the vehicle to convert the option premiums to a coupon. Nice little coupon. So it is real income and not potential capital gains. This is all in order to ensure they have bona fide, or let's call it genuine income and not ROC, right? Return of capital, giving your basis back. So they're giving you real income and not some of your basis back like you might see in some other instruments. But finally, at 21 minutes and 50 seconds, we get to the ELN discussion, which is probably why most people watch the interview in the first place, to understand these things a little bit better. But he says, he kind of repeats, the ELNs are a combination of two things, some equity market exposure plus short options so that it is paid out to investors as a coupon for income reporting. So ELNs are capped at 20% in both strategies, but usually around 15%, and they're a max 4% per issuer, per bank. Short-term duration are typically used from 1 month to an average of around 2.5 weeks. So what's your expiration on the options that you like to pick? At about a month to 2.5 weeks is the average. So it appears the ELNs are all about a delivery mechanism to ensure they can distribute monthly income. Finally, around the 24-minute mark, they talk a little bit about portfolio composition, and he stresses that nothing in either one of these funds will be over 2% of the fund, and they're looking for things such as price volatility and earnings variability, anything that can help them lower the beta overall. So looking for high-quality stocks that can hang in there in a down market. So he says that JEPI should have a beta of around 0.8, but by selling these call options against there, we should get down to about a 0.65 beta. So not this this, right? So lowering the volatility and beta overall of the fund. Now JEPQ will be slightly higher beta, but it'll still be under 1. So overall, that's what we're looking for. Low beta, low volatility within the fund. So those are my highlights from this interview, but I thought it was great that Hamilton came on, gave us some of his time and interviewed and clarified some of these different sticking points of JEPI and JEPQ in these ELNs. So I think that probably will allow some people to comfortably invest in these two products. And credit should also go to Adriano from Passive Income Investing for grabbing that interview and putting all this great information together. So again, support his channel, watch the whole interview. I'll link that down below. Now for people like me and like Bryn, who are a little skeptical in the market, maybe still a little bit bearish, I'm more comfortable investing in this right now than I am in some other products. But again, I'm not going to hit the highs, I'm not going to hit the lows, I'm going to peel off some income, lower my beta overall of my portfolio, so that works out well for me. Now, if you have any questions on any of this, please ask down below. I really appreciate you watching. Like and subscribe if you like this type of content, and we'll see you next time. Take care. Whoop.